U.S. Farm Report on the Road from the Missouri Governor's Conference on Agriculture is brought to you by the Missouri Department of Agriculture, celebrating the determination and tenacity of Missouri's farmers and ranchers.
Welcome back to U.S. Farm Report from right here at the Missouri Governor's Conference on Ag, and excited today to really focus on the cattle market. We talked about the chaos in the cattle market a little bit earlier, but really giving some analysis to what we're seeing today. So in order to do that, we have Daryl Peel as well as Lance Zimmerman and Brian Wiggin joining us today. Daryl, I will start with you because I want, there's been a lot of comments from the White House about cattle prices, about beef prices. I mean, in your opinion, did cattle prices get too high?
Well, there's a speculative element to these markets, so there's always an opportunity to push it a little high, and we see corrections in that. I don't know that we were fundamentally that much too high. This market has very strong fundamental foundations for why we are where we are.
Yeah, and let's talk about some of those fundamentals, Lance, because when we look at the small cow herd, when we look at demand, none of that has changed. And so do you think the market fundamentally does support higher cattle prices from here?
Yeah, what's interesting is we want to talk about tighter supplies. We recognize the cow herd has been in decline since the highs in 2019, but per capita beef supplies, which really influence the market prices, are relatively steady. We've been between 58 and 59 pounds a person for the last 6 years, this year included in that. And so a lot of the price increase that we're seeing, we talk about record high beef prices, actually come from record high demand, or at least the strongest demand we've seen in many of our lifetimes, highest since 1983 based on our models. And so as we talk about these record high prices and how do we bring them down, it creates some pause when you realize the main reason for the prices we're paying today is actually the demand side of the equation, not the supply side, which is still going to come tighter the next several years.
Yeah, do you agree with that, Daryl? Do you think we have seen the tightest cattle supplies that we're going to see, or do you think it will continue to get tighter?
No, I think the cattle supplies will continue to get tighter. Again, we've tightened up this feeder supplies. We've masked that a little bit at the feedlot level, but the feeder cattle supply out in the country is extremely tight. And we still don't have any, fundamental data that says we're retaining enough heifers to rebuild this industry. So the tightest supplies are ahead from that standpoint, and that means, to your point, that beef production is going to fall more, and per capita supplies, which is consumption, is going to tighten up more for the next couple of years at least.
And so then, Daryl, based on that, how much longer do you think we will see these elevated cattle prices?
Well, I think we could see elevated cattle prices probably for much of the rest of the decade. In terms of, obviously we get asked a lot, when's the peak at? History would tell us that, maybe a year to a year and a half after we know that we're saving heifers for rebuilding, we might put in some sort of peak. And I'll go ahead and say this now, obviously one of the concerns is that we peak and we drop sharply like we did about a decade ago. I think that's a very different story now. We're on a completely different, slow-paced path, probably the slowest rebuild in history, whereas the one a decade ago was the fastest in history. So it's a very different model right now, but we remember that, and that's on a lot of people's minds right now, I think.
Lance, do you agree with that?
I do. I think one of the things as we talk about the highs we're seeing today, markets tend to be anticipatory, and markets are moving a lot faster than we've ever seen before. And I think if I look at the prices we've seen really through most of the second half of this year, I would say that actually reached a price point I didn't think we were going to get to until next year in many cases. But I do think the market is trying to figure out how do we ration this tighter supply that we see coming. And one thing Daryl didn't even mention that I think is still looming large in these markets, I think it got priced into the feeder side, and that is the lack of Mexican imports. Yeah. And we see it with double-digit % declines on cattle on feed in a lot of those southern yards. But that's not going to come to the fed cattle market and slaughter until really this fourth quarter window we're in, and really next year. And that's worth another 800,000 to 1 million head decline in slaughter, all else equal.
I agree.
Brian, one thing we haven't been talking about a lot is packer margins. And packer margins are in the red, deep in the red. So how steep of losses are we talking? What impact could that have?
Yeah, so I think that's maybe not the popular thing that you have a discussion about if you're on the producer side. We will believe that the packer is really in the space and they're turning a margin. But if we look at the data right now, we have some that are 8 quarters in the red, in the money. So right now, it's certainly the margin sits in the feeders space. And as we look at commodity prices, where we are right now, we're in a spot we haven't been in for a long time in terms of corn. So right now the data says feed the cattle, and the cattle are worth a lot, and the packer margin is it's not just tight, it's upside down.
And is that going to continue for the foreseeable future?
Well, I think it's going to have to for a little bit. One of the things we talked about a little bit earlier before we even got into this part of the conversation is the control of that market. We know 90-some% of that market is with a small number of packers. They're also in other protein businesses too. So the question maybe for them is how long can they weather it in those other protein businesses and stave this a little bit, but that's not long-term financially viable for them as well. So I think we're probably in some negative margins for a bit here.
Well, Daryl, that was going to be my question for you. Do you think we will see consolidation on the packer side just because of the negative margins they're seeing today?
Well, there's certainly a limit to how long they can go. I don't think we're there yet. I don't see any indications of that. They knew this was coming and prepared as best they can. As Brian mentioned, they're diversified in lots of other markets and geographically around the world. So that gives them a little bit of time. But there is a limit at some point in time. They're all going to hang on as long as possible, because if you give up market share in this market, it's going to be tough, if not impossible, to get it back. So nobody's going to give up willingly. They're going to hang in there as long as they possibly can. But again, there is a limit, and we don't know exactly where that's at.
All right, let's get back now, Lance, to cattle prices, because it does seem like the psychology of the market has been damaged. We have a statement that comes out from the White House or from D.C., and definitely we saw the funds be impacted and saw them exit. What is the catalyst, do you think, to get interest back into the cattle market and push these prices higher again?
Absolutely. When you look at these markets, we saw it in the second half of this year that we had a near record long position held by speculative traders in the futures markets, both live cattle and feeder cattle futures. But here's the interesting thing about those futures markets. Yes, they're paper markets, but they're cash settled. One forces it by delivery, one forces it by the CME feeder cattle index cash feeder prices. As we go through this, those markets have to come back to fundamentals. And so we're in a period of time right now in this short run where the market's basically telling the cattle market, prove it to us. Prove it to us that it's worth what it is. And so we're going through a period right now where basis levels are really strong. In other words, that cash price is really strong relative to that underlying futures price, even as it's come under pressure. As we go forward, it's going to come down to demand and supply in showing that it's worth the valuations that we priced in earlier this year. To Daryl's point, I think maybe we got just a little bit ahead of it for a time being, just a couple dollars a hundredweight, maybe as much as $10 a hundredweight in some of those markets. But as we go forward, I think the supply and demand picture is favorable enough that we can get back to those levels and exceed them the next year or two.
Daryl, we heard the comments that not only cattle prices were too high, but beef prices were too high. When you look at consumer demand, does it indicate that beef prices have been too high?
I think the market's telling us that there's not beef prices are not too high. Consumers are willing to pay what they're paying. There's plenty of alternative proteins out there. There's other sources that people could turn to. And so, I think the market's working fine. It's easy to pick out a target here. And when there's a lot of focus on inflation and components of inflation, and that's always dangerous when you start singling things out as elements causing inflation and so on. So I don't think beef prices are too high for the marketplace. Consumers can and will turn away when if that's warranted at some point in time.
Brian, we know also some comments made on launching an investigation by the DOJ into meatpackers and the consolidation into meatpackers. Missouri's doing some interesting things and really trying to focus on those small and medium-sized processors. So in your opinion, the work that you're doing, what is it going to take to beef up that processing outside of the four major meatpackers across the U.S.?
So I think that's an interesting place to think about. So here in Missouri, we've created some incentives for our small and very small processors. A lot of that was around increasing their cold storage, increasing some of their opportunities for upgraded equipment. Again, you've got some businesses that are really squeezed on labor, but a lot of those aren't really the do-all things in the processing space. A lot of them have gravitated into some value add, so some of them may not be operating in the slaughter space. So at the end of the day, they're probably affecting their local economy pretty nicely at times. But when you take a look at them, they're just a blip, a really small blip on the big scheme, because again, 95+% of that market is in the space of about 4 entities. So, but here in Missouri, we are trying to incentivize that, and consumers are finding us in that space. with some of the buy local, which we came out of COVID, and buy local had a head of steam that we've never seen before, really against some of the other label claims as well. So it's been interesting to see where that market's landing. I think we'll continue to see those carve out a small piece of this business.
Well, Brian, Lance, Daryl, thank you so much for joining us. We need to take a quick break, and then we'll be back with much more on U.S. Farm Report.